And welcome back to Overnight Accountants course on Realtors and Reducing Taxes. In this section, we are going to move into actual auto expense. Remember, there's two ways you can claim auto expense on your tax return. One is a standard mileage rate, which is relatively simple, and the other is claiming actual auto expenses, which can be, as you're going to see, fairly complex and time consuming. But if you're a full-time agent and you have a dedicated business vehicle, this may be a better deduction for you. It also may be a better deduction if you have say you have a large SUV or a large vehicle that gets poor gas mileage. That could be more beneficial than the standard mileage rate. Or let's say you have an expensive vehicle. Now this may allow you higher depreciation and also a higher insurance deduction, because those insurance, of course, is going to be more expensive on a more expensive vehicle. Depreciation, however, which we discussed in a later section, may be limited. Now, I want to remind you, if you're not already aware of that, this is an audit risk. So not so much as it used to be, but it's still what we call a red flag on a tax return. Because, the reason for that is the IRS knows that if they look at your return, there are so many mistakes made in this area of claiming actual auto expenses that they pretty much know they're going to ding you on something. So just be aware, we want organized individuals only, please. If you're going to claim this, please, you're going to have to be organized in order to do it and able to prove your deduction later and actually maximize the deduction. So this is often a higher deduction if you use more than one vehicle in your business. Now I'm going to explain that a little bit, but this is one good strategy. If you have more than one vehicle in your household, you can actually maximize your deductions far more than using just one vehicle actual auto expenses, and even more than the standard mileage rate. So let me show you how this works a little bit. The reason is because it's based on the percentage of business use. All your actual expenses are based on percentage of business use based on mileage. So let's say you have one vehicle that 60% of the miles driven during the year are for your business use, for showing properties or whatever you're doing in your business, and you've kept good records, as we discussed earlier. So that's the main vehicle used for business. However, let's say you have a sports car. Let's say you have a much more expensive car that you garage keep. Maybe you only drive on the weekends or on special occasions. Just go out as kind of your hobby car, or your you might call your toy car, or whatever you may want to call it. But you have a much more expensive car that you really want to keep the mileage down on. However, let's say you may only driven the car, a few thousand miles over the year, but you find out you make sure you use the car at least once a week. You make sure you're doing business trips with that vehicle, and 80% of the business use, or the mileage driven during that year, winds up being business use. So as you can see, that creates a situation in which you're going to be able to take 60% of the expenses on your regular vehicle, but also you just got to claim 80% of the interest on the car loan, your insurance, and all expenses related to that vehicle because of how many miles you drove it for business use. So those two added up can become quite a substantially higher deduction than claiming it just on one vehicle alone. So keep that in mind if you're a full-time agent and you have more than one vehicle. This is a good plan for you to save some tax money. I want to let you know also, and this is one of the complicating factors of doing claiming actual expenses, is you must depreciate the vehicle. We're going to discuss this in a later section, but this can be highly complex. You may also claim what is called bonus depreciation, which is you can write off a certain amount of the vehicle's cost in the first year, but these are limited. Also, you may be able to claim 179 expense, which allows you to write off an elected amount of the vehicle the first year you place it in service. However, as I said, these are complex and there are qualifying rules. We'll go over this in a later section. However, this is one of the reasons that we do recommend that if you're claiming actual auto expenses, you do get a professional to prepare your return. These items can carry forward year after year, claiming actual expenses for this, and also the home office deduction is the same deal. What you do one year can influence every year after that, and if you're not very careful with your software, you could really mess up your return. Do it one year and every year after that. So one of the complicating factors of this, why we want to organize individuals, is now you not only need to track your mileage as you do with the standard mileage rate, but you also now must track all expenses related to each vehicle, and you have to break it down by vehicle because that's how you have to report it on your tax return. You must be able to prove the deductions claimed, which means you're going to need to keep records, receipts. You're going to have proof of all the actual auto expenses related to each vehicle that you use for business. Now, most of the allowed deductions is based on the percentage of business use. As I said earlier, it's based on percentage of miles used. Now you're going to need to categorize all annual cost for each vehicle used for the business. And where this can get complicated is you need to separate cost out. Say property taxes, oftentimes you'll receive one bill or pay one bill for all the vehicles in the household. So if one of those vehicles is used for business, you're claiming actual expenses, you're going to need to show through some logical proration how much of that property tax is based on the vehicle you use for business. And also you're going to need the same with insurance. Now some insurance companies will bill you per vehicle, but oftentimes other insurance companies, you're going to get one lump sum bill for all the vehicles. So somehow you're going to need to talk to your agent and say, well, how much of that insurance was for the vehicle that you use for business? So just keep that in mind. You're going to need to keep receipts for fuels and repairs. Receipts are going to be very important because you're not going to know if you're going to a convenience store and buying gas. The IRS isn't going to know that you're purchasing fuel without a receipt and not going in there and buying donuts and coffee or other items at the convenience store. So it's very important you keep receipts. Don't just rely on your bank statements or your credit card statements. You're going to need to keep receipts for this to prove what was actually purchased. And that can be an issue, as you know. One of the challenges is oftentimes we're almost using like what we used to call fax paper for a lot of these receipts to print out, and they fade in the sunlight or over time. So you need to make sure you keep those receipts in good condition. If you use actual cost the first year you get a vehicle, you cannot switch to standard later. So the first year you put a vehicle in service, if you don't claim a standard mileage rate, you claim actual expenses instead, you must then use actual expenses year after year. Any depreciation that you claim other than straight line depreciation, you cannot switch back to standard. So therefore, oftentimes we'll say that's a good idea to start when you first place a vehicle in service that you claim a standard mileage rate the first year. If you're not sure that you really want to go through all the stress related to tracking all your actual expenses for the next 5 to 6 years on a vehicle, it's good to do the standard mileage rate the first year so you can switch back and forth later if you claim what's called straight line depreciation on the vehicle. So let's move into actual costs. Let's discuss what's actually deductible in the actual cost method. Costs are based on a percentage of business use percentage based on mileage, your fuel and your gas, repairs and maintenance. You see I have an asterisk right here for repairs and maintenance. We'll get back to that in a few moments. Registration fees, property taxes on the vehicle, insurance, garage rent. If you're keeping the vehicle in a garage and you have to pay rent on that garage, that would be a deductible cost. Tires, of course. Depreciation, as I mentioned earlier, you have to depreciate it. We just see so many tax returns. Folks do it themselves. They try to claim actual expenses. They mess it up in a couple ways, but one of the common things is that they don't depreciate the vehicle. And if they depreciate it in their software, they do it improperly. So you must depreciate the vehicle. Car washing and detailing. So if you do that, every 6 months or so, you get a detail job done, or you wash the car once a week. Those are actually deductible costs based on the percentage of mileage use. Interest on car loans are deductible. They're deductible on a different line, but they are deductible. Lease payments, and lease payments are considered rent, so a lot of folks rent their vehicles now. We're going to discuss this in a later section. At the end of this section, we're going to discuss what to do with the leased vehicle, how they're treated with the actual cost method. Now, business trip costs, if you have specific costs related to a business trip, you can deduct 100% of these. Your business trip tolls, if it's on a business trip, which we discussed in another section. Business trip parking. Now, if you go to a business trip, say you got to feed the meter, if you can prove it. Business trip parking, now not your main office. So if you have a broker's office, you're staying there, and you have to pay, cost of parking there, that's really probably not going to be deductible. Even if you have a home office, I probably wouldn't push it with that if you're going to the broker's office. However, if you're at a meeting or an event or a closing, yeah, definitely track your parking costs. Now, commuting costs are not deductible. So remember, we discussed if you have a home office or don't have a home office, that can tie directly into this. The home office is very important for maximizing your mileage. But commuting costs, if you don't have a home office or do a second or third job, remember, commuting costs are never deductible. You can also not, if you get a speeding ticket, if you have a lead foot, you drive a little fast, you cannot deduct parking tickets. You cannot deduct fines for breaking a law or an ordinance, such as speeding. So remember, those are not deductible. Now let's return. I've discussed repairs and maintenance earlier. Let's discuss a little bit about repairs and maintenance. Now, normal repairs and maintenance are deductible. However, let's say you have a major repair. Let's say you replace an engine or something like that, or you improve the vehicle. These items may need to be depreciated. Remember, normal repairs maintain operational operational, and they also maintain the value. So they keep the vehicle in a good operating condition and they maintain the value. An improvement, however, is going to alter the vehicle, add value, or substantially increase the life of a vehicle. So let's go through a few examples here. Oil change on a regular basis, that would be considered repair. Deductible based on the percentage of mileage used during the year. A new starter, okay, your starter went out, repair, you're keeping it in operational condition. However, let's say you have a truck and you want to raise it up so it looks cooler, so you get a lift kit underneath it. That would be an improvement. That would be an example of an improvement. Let's say you put a really nice stereo in a vehicle. You spend $600 or $700 putting a really nice stereo system in your vehicle. That would be considered an improvement as well. New engine, put a new engine in the vehicle, improvement. So window tinting, you're not keeping operational condition. That would also potentially be considered an improvement. Now remember, we discussed depreciation. There's generally like a $500 safe harbor. So if it's under $500 for a particular item, you're probably okay and going ahead and writing those items off as a repair. However, if it's over $500, you really need to look here and ask yourself, is it an improvement or is it truly a repair? So how do we go about reporting actual costs? Now, generally, there's another form, and this is actually form 4562 is really the depreciation form, but the mileage for actual cost, because you need to depreciate the vehicle, that is generally reported on page 2 of the 4562. So if you're using software or you have your professional do it, you should see the mileage reported there because most of these vehicles are what we call listed property. Business auto expenses, however, are reported on line 9 of the Schedule C. So if your Schedule C printed out, you can see that on line 9. That is where the actual auto expenses are reported. And depreciation would flow through from page 2 of the 4562, and it would actually be, or the 4562 in general, and it would be reported in the depreciation line on your business auto expenses. Now, interest can go on line 9, auto expenses, or line 16B, other interest. Oftentimes we want to put that on other interest just so you're not really loading up your actual auto expenses. But it's one of those areas where you can put it in either place. 16B, we're going to discuss in a later section. That's called other interest, and you can report it there. Now, most software is going to provide you a worksheet that you can print out and take a look at to make sure it was done properly. Be very careful entering your software, though. Depreciation, I said earlier, is calculated, reported separately. It's going to be on line 13 of the Schedule C. Let's run through an example here of reporting actual costs. Let's say your total mileage for the year was 25,000 miles. Now, your business miles for the year that you have documented, and I'm using round numbers, just keep it simple, but what you've documented were 17,000 miles. So that you divide 17,000 by 25,000, you end up with a rounded figure of 68%. So 68% of the miles driven during the year were business use. So that's how I got the figure. Now, total actual auto expenses, you've lined all those up. Your total actual expenses, repairs and maintenance, fuel, insurance, and all that stuff, property taxes, all that, were $13,000 for the year. Your interest, however, was $2,300. So how do we go about doing the calculation? Your actual auto expenses on line 9 is going to be $13,000 times 68%, or $8,840. That's a nice tax savings. Some nice tax savings on that $8,840. Now, the interest is going to be reported on line 16B. You're going to take the same percentage. And your software is going to do this if you're using your own software, or your professional is going to do it, but we want to make sure I want you to understand how this process works. Your interest is $2,300 times 68%, or $1,564 of interest that you can deduct on the vehicle. Using more than one vehicle, of course, you're going to go through this twice, once for each vehicle. Your software should have a separate screen for that. Make sure you do it on a separate screen. Don't bunch them all together. Now, depreciation is going to be calculated separately based on the purchase price of the vehicle and the percentage of business use. So that's really it for the actual auto expenses section. If you have any questions, please go back and rewatch this. Check our website for more material or information that can help you in the resources section on our website. Now, before we move forward, I want to discuss notes on leased vehicles. I believe up to 20 to 25% of vehicle purchases now aren't really purchased, they're leased. So it's very important that you understand how to treat those leased vehicles on your tax return. I'm not going to discuss the financial benefits or lack thereof, or which is better as far as leased vehicle versus actually purchasing a vehicle outright, but let's discuss how to treat this for tax purposes. So if you use the standard mileage rate, you must use the standard mileage rate through the whole lease term, the whole lease period. You cannot deduct the lease payment. So what first year you put that vehicle in service, if you use the standard mileage rate, you got to use it the whole time. You can't deduct actual expenses. You can't deduct the lease payment. If you use actual costs, the deductible lease payment is reported on line 20A. So it's still treated like everything else based on percentage of business use. It can get a little complicated. We'll discuss why, but it's reported as a rent on line 20A. It's not reported on line 9. So just want to make sure you're aware of that. You can deduct the lease percentage of business use. So in our example, 68% that we discussed earlier, if you were using 68% of the vehicle for business use, basically you can deduct 68% of your lease, but there are limitations. We'll discuss those in a few minutes. Now, if you have a down payment, so a lot of these leases will say you have to have $2,500, $3,500 down, then your lease term starts. You can't just deduct that the first year. Any down payment or an advance on the lease must be deducted over the term of the lease. So if it's a 60-month lease, you're $2,500 down on the lease, and then you start making your monthly lease payments. That $2,500 has to be divided up by 60 months, and then depending how many months are in the year, how many months you use the vehicle during the year, 12 months during a whole year if you have the vehicle for the whole year, but you got to divide that up and prorate it over the lease term. It's important to remember that. Sometimes the software might have a problem with this. So I want to make sure you're aware of that, and your professional needs to know about that too. If you have a down payment, oftentimes they won't tell you. I know that from experience. Someone has a leased vehicle, they may not say you put $3,500 down on it, and if you're preparing a return for somebody, you don't have a copy of the lease oftentimes. So it's important that you tell your professional this to maximize your deductions and not make a mistake. If the lease, now you see this with larger vehicles, mainly with trucks and more equipment that's leased, not so much with vehicles, however, but if you are on an own part of that vehicle or that vehicle within the lease term, you're really not leasing it. It's actually treated as a purchase, and you need to depreciate that vehicle. I suggest you get a professional if you're in that boat. Your lease deduction, however, as I mentioned a few moments ago, it's probably going to be limited. And it's going to be limited for most vehicles. Let's just say for, like this word here, luxury vehicles. $19,000 or more is considered a luxury vehicle for purposes of a lease according to the IRS. So this depends on the year lease. So it's the year you place the vehicle on service. You got to look up and see whether or not that leased vehicle is considered a luxury vehicle, and your lease is limited, the amount you can deduct on your lease. Be careful with your software on this if you're a do-it-yourself tax preparer. Hopefully it has a section there where you can plug this information in and everything comes out fine, but you really have to watch it, make sure it does it right. Okay? Now the deduction is reduced by what we call an inclusion amount. So you're taking it, there's a table that you use based on the lease term, well, the amount of the vehicle based on the year it was placed in service, and there's a certain amount that you have to reduce your expense by, and it kind of be a little confusing because it's called the inclusion amount as though you're adding it, but you're really subtracting it. So you have to do that, and you're going to use a table. It's in the back of IRS Pub 463. That should be on our website for you, so you can download that and take a look at it just so you can see, or you may not want to print it, but you could take a look at it as a PDF file and check it out and see what I'm talking about there. Now, if you're using actual costs for a leased vehicle, all other costs are reported on line 9, just like they are under the actual expenses rules. The only item that's going to report it in another place is going to be the actual rent section. You're probably not going to have interest on it, of course, because it's a leased vehicle. And I think that's part of the reason they do the inclusion amount, because you're actually, part of that profit is going to the, part of what you're paying is kind of implicit interest rate on the leased vehicle that the lessor is charging you or including in the lease. Don't need to go into all that. But anyways, that's it. And that's it for this section on actual auto expenses. We'll catch you in the next.